As of 10:12 a.m. Eastern Time on September 17, 2025, AMC Entertainment Holdings Inc. is trading at $2.87, down about 0.86% for the day. Now, the immediate reaction for most is to lump this into the usual chaotic swings of a meme stock, a simple narrative of retail versus the shorts. But what the surface-level data fails to show is the increasingly sophisticated options activity, suggesting a divergence in strategy between short-term speculators and long-term believers. While daily volume appears average, a closer look at the off-exchange short volume ratios from the past week reveals a consistent pattern of significant dark pool activity. This isn't just noise, it's a calculated positioning by larger players that contradicts the public-facing story of a simple retail-driven battleground. This is where the real story begins, far from the headlines and social media chatter. The expectation is that AMC's fate is tied exclusively to box office hits and the sentiment of its passionate retail shareholder base. The reality is that its future is being quietly shaped in the opaque world of debt financing, institutional share accumulation, and complex hedging strategies that have little to do with the success of the next blockbuster. The common belief, the one that has fueled this stock for years, is that AMC is a populist movement manifested in a ticker symbol. It represents a stand against Wall Street elites, a bet on the enduring magic of cinema, and a belief that a united community of individual investors can defy traditional valuation metrics. Millions of traders, many using accessible platforms like the Robinhood app, SoFi Invest, or Fidelity, have held on through immense volatility, driven by this powerful narrative. The expectation is that loyalty and sheer numbers will eventually trigger a massive short squeeze, vindicating their investment and rewriting the rules of the market. This belief system isn't entirely without merit. It has certainly created unprecedented price action and forced many seasoned financial analysts to reconsider the power of collective retail sentiment. When you see a stock like this move, it's easy to get caught up in the emotion, especially when you compare its explosive potential against the more predictable movements of a behemoth like Apple stock or even the high-growth trajectory of Nvidia stock. However, the reality of AMC's situation is far more sobering and complex, a truth buried beneath layers of debt and corporate maneuvering. The company is navigating a treacherous financial landscape. According to its latest filings, AMC carries a total debt load of approximately $4 billion against a negative shareholder equity of over $1.7 billion. This creates a debt-to-equity ratio that is deeply concerning from a fundamental perspective. While the company has made commendable efforts to restructure and extend its debt maturities out to 2029, this doesn't eliminate the burden. It merely postpones the reckoning. The interest payments alone are a significant drain on cash flow, forcing the company into a perpetual cycle of needing blockbuster-level performance just to service its obligations. For investors using more advanced platforms like interactive brokers for deep fundamental analysis, or those relying on managed solutions like Schwab Intelligent Portfolios, these numbers represent significant red flags that sentiment alone cannot erase. The reality is that massive shareholder dilution over the past few years has fundamentally altered the equity structure. While this was necessary for survival, it means the per-share value of any future success is significantly diminished. Let's focus on the recent market dynamics because that's where the tension between these two narratives is most visible. Over the last few trading sessions, we've seen AMC's price action become increasingly tied to broader macroeconomic indicators rather than just company-specific news. When inflation data comes in hotter than expected or the Federal Reserve hints at a more hawkish stance, AMC tends to suffer alongside other high-debt consumer discretionary companies. This is because the expectation of higher interest rates makes its debt burden even more expensive to manage and signals potential trouble for consumer spending on non-essential items like movie tickets. We've also observed significant block trades occurring in the pre-market and after-hours sessions, often masked from the average retail trader looking at their SoFi or Robinhood stock trading app during regular hours. These large volume transactions suggest that institutional players are actively managing their positions, perhaps selling into strength or accumulating on dips, with a strategy that spans far beyond the next quarterly earnings report. The short interest, while still notable at around 9.7% of the float, is not at the astronomical levels seen during its peak squeeze, indicating that while the bear thesis is present, the dynamic has shifted from an all-out war to a more strategic, long-term standoff. To understand how we got here, a brief look at the business is necessary. AMC is, at its core, the world's largest cinema operator. Its business model is straightforward: sell tickets to movies and generate high-margin revenue from concessions. The pandemic brought this model to a complete standstill, pushing the company to the brink of bankruptcy. It was saved by a combination of debt issuance and, most critically, the unprecedented inflow of capital from retail investors who bought newly issued shares in mass. This capital allowed AMC to survive, but it came at the cost of immense dilution. Post-pandemic, the company faces a changed landscape. While the movie theater market is projected to grow globally, reaching over $68 billion in 2025, it faces persistent competition from high-quality in-home streaming services. The expectation is that epic films will always draw crowds, but the reality is that the bar for what constitutes a must-see in the theaters event is now much higher. The industry is responding by investing in premium experiences, IMAX, Dolby Cinemas, luxury seating, to differentiate itself, but these upgrades require significant capital expenditure, a difficult proposition for a company as heavily leveraged as AMC. Now, let's turn to the future outlook, where the divergence between expectation and reality will ultimately be resolved. One possible scenario, the one hoped for by its most ardent supporters, is a perfect storm of positive catalysts. This would involve a string of massive, record-breaking box office successes that far exceed current projections, allowing AMC to generate significant free cash flow. This inflow of cash could then be used to aggressively pay down debt, strengthening the balance sheet and improving profitability. In this scenario, improved fundamentals could attract a new wave of institutional investment from firms using services like Fidelity Wealth Management for their clients, validating the retail thesis and potentially forcing remaining shorts to cover their positions, creating a sustained upward trend. This is the grand expectation. Do you think the upcoming slate of holiday blockbusters have the power to genuinely alter AMC's financial trajectory? Comment below with your honest box office predictions. The alternative scenario, and the one that the debt metrics point towards, is a continued struggle for profitability. In this reality, the box office recovery remains sluggish, failing to consistently reach pre-pandemic levels. The high interest payments continue to consume operating cash flow, preventing any meaningful debt reduction and limiting investment in theater upgrades. The company might be forced to consider further dilutive share offerings, placing additional pressure on the stock price. This is a path of gradual erosion, where the weight of the balance sheet eventually overshadows any temporary boosts from hit movies. This is the cold, hard reality presented by the numbers, a reality that sophisticated investors using comprehensive trading platforms like Interactive Brokers or those managing their retirement through Fidelity IRAs must consider. It's a stark contrast to the high-flying growth stories of stocks like Tesla stock or Nvidia stock, highlighting the unique risk profile of an investment in AMC. It's not a typical growth or value play. It's a highly speculative bet on a very specific and challenging turnaround story. In summary, the story of AMC stock is one of the most compelling dichotomies in the market today. The expectation is a cinematic tale of a people's stock defying the odds, a narrative of community and conviction triumphing over fundamental weakness. It's a powerful and alluring story, and it has been the stock's primary fuel for years. The reality, however, is a far more intricate and precarious financial situation, dictated by the unforgiving logic of debt covenants, cash flow, and shareholder dilution. The live price of $2.87 is not just a number. It is the current equilibrium point between these two titanic opposing forces. The ultimate direction of the stock will not be determined by sentiment alone, but by whether the company's operational performance can fundamentally alter the grim reality of its balance sheet before the weight of its obligations becomes insurmountable. Understanding this core conflict, this chasm between the passionate expectation and the mathematical reality, is the only way to truly grasp what is at stake with an investment in AMC Entertainment.